Hello, fellow compounders. Welcome back. For those who are new to the club, I'm Dennis Chen. I've been a hedge fund manager and management consultant. I earned my MBA at the Wharton School, and now I'm a full-time investor who's achieved financial independence. And I want to help you grow your wealth so you can achieve financial independence faster. Today, we'll break down two key investing strategies: growth investing and dividend investing. Each of these approaches has its own strengths and fits different types of investors. So let's get into which might be right for you. By the way, at the end of this video, I'll be giving away a free reference guide to growth and dividend investing using ETFs. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you're responsible for your own financial decisions. You probably heard the saying, investing for growth is for getting rich, and investing for dividends is for living rich. But what does that really mean? Let's explore each strategy in a bit more detail. Growth investing is all about focusing on companies that are growing fast. We're talking about businesses that are reinvesting most of their profits back into themselves to expand and innovate. These companies typically don't pay dividends because they can deliver more value by using their profits for future growth. For example, companies in sectors like technology or biotech often follow this approach. For investors, growth stocks offer the potential of high returns, but they also come with higher volatility. Growth investing is ideal for those who have a long-term horizon and a higher risk tolerance. Think young professionals, ambitious investors, or anyone who's trying to build significant wealth over a couple of decades. If you're still in your accumulation phase and willing to ride out the ups and downs of the market, growth investing could be perfect for you. A simple growth-focused portfolio can be built with just a few ETFs. For example, SCHG, Schwab US Large Cap Growth ETF. We can allocate 40% to this ETF in the portfolio. This ETF focuses on large cap growth companies like Apple, Amazon, and Google. It has a 5-year annual average return of 20.4%. It has $33.4 billion in assets under management, and it has a very low expense ratio of 0.04%. 4 basis points. We also can allocate 35% to QQQM, that's Invesco's NASDAQ 100 ETF. This ETF tracks the NASDAQ 100 and provides exposure to many high-growth tech companies. The 5-year average annual return is 21.25%. It has $34.6 billion in assets under management, and it has an expense ratio of 0.15%. And third, we could allocate 25% to round out the portfolio to VGT, Vanguard's Information Technology ETF. This ETF provides broad exposure to technology companies, including established innovators like Apple, Microsoft, and Nvidia. The 5-year average annual return is 23.03%, and it has $79.3 billion, almost $80 billion in assets under management. It has an expense ratio of 0.1%, or 10 basis points. These ETFs give you exposure to high growth companies across different sectors, and holding them for the long term can help you benefit from compounding growth. Now let's shift gears and talk about dividend investing. Dividend investing focuses on companies that consistently pay out a portion of their earnings to shareholders in the form of dividends. These are often stable, mature companies that generate a lot of cash. Think of sectors like utilities, consumer staples, and healthcare. For investors, dividends provide a steady stream of income, making this strategy especially appealing for those who want to live rich by enjoying a reliable cash flow from their investments. Dividend investing is ideal for retirees, those nearing retirement, or anyone looking to generate passive income from their portfolio. A simple dividend-focused portfolio could include 30% of VYM, which is Vanguard's High Dividend Yield ETF. This ETF focuses on large companies that pay high dividends, such as Johnson & Johnson and Procter & Gamble. The 5-year average annual return for this ETF is 11.55%. It has around $60 billion in assets under management, and it has an expense ratio of 0.06%, 6 basis points, and a dividend yield of 2.8%. We can also allocate 40% to Schwab US Dividend Equity ETF, SCHD. This ETF targets companies that have consistently paid and grown their dividends over time. Its 5-year average annual return is 13.29%. And it has $63 billion in assets under management. The expense ratio is 0.06% and a dividend yield of 3.4%. And the third ETF for this portfolio is DGRO, iShares Core Dividend Growth ETF, with a 30% allocation. This ETF targets companies with a history of consistently growing their dividends. It has a 5-year average annual return of 12.78% and assets under management of $30.4 billion. It has an expense ratio of 0.08% and a dividend yield of 2.2%. The dividends from these ETFs can be reinvested for growth or used as a source of income. The choice is yours. This is what we mean when we say dividend investing can help you leverage. It gives you the freedom to have regular cash flow without selling your investments. So, which strategy is right for you? Growth or dividends? But remember, it's not always about choosing one over the other. Many investors have a combination of both in their portfolio, using growth stocks to build wealth and dividend stocks to create cash flow. You could consider a core and satellite approach, where the core of your portfolio consists of your primary objective and the satellite consists of your secondary objective. So let's say your primary goal is to have income. Then the core of the portfolio will be made of steady dividend-paying ETFs, with some growth ETFs as satellites to supercharge your returns. On the other hand, if your primary goal is growth, then your portfolio's core will be consisting of growth-oriented ETFs with some dividend ETFs as satellites for income. Here are two examples of core satellite ETF portfolios, each designed to balance growth and income in different ways. Example number one, a core dividend with growth satellite portfolio. The core holdings are 70% of the portfolio, which are dividend focused. And here are the ETFs that goes into it. SCHD, Schwab US Dividend Equity ETF at 30%. BYM, Vanguard's High Dividend Yield ETF at 25%. And DGRO, iShares Core Dividend Growth ETF at 15%. Now the satellite holdings, which is 30% of the portfolio, are growth focused. So here are the ETFs. SCHG, Schwab US Large Cap Growth ETF at 15%. QQQM, Invesco's NASDAQ 100 ETF at 10%. And VGT, Vanguard's Information Technology ETF at 5%. Example number two, this is the other side. Core growth with dividend satellite portfolio. The core holdings, or 70% of the portfolio, are growth focused. So here they are. VTI, Vanguard's Total Stock Market ETF with a 30% allocation. This gives you broad exposure to the entire US equity market, providing diversification. The 5-year average annual return for this ETF is 15.3%, and it has around $766 billion in assets under management and an expense ratio of 0.03%. QQQM, Invesco's NASDAQ 100 ETF with a 25% exposure. It provides exposure to the high growth companies in the NASDAQ 100. Its 5-year average annual return is 21.87%, and it has $34.6 billion in assets under management and an expense ratio of 0.15%. And VXUS, Vanguard's Total International Stock ETF with a 15% exposure. This provides exposure to international stocks, providing global diversification. The 5-year average annual return is 6.9%. It has $57 billion in assets under management and an expense ratio of 0.08% or 8 basis points. The satellite holdings for this portfolio are 30% of the portfolio, which are dividend focused. We have SCHD, which is Schwab US Dividend Equity ETF with a 15% allocation, BYM, Vanguard's High Dividend Yield ETF with 10%, and DGRO, iShares Core Dividend Growth ETF with 5%. These two core satellite examples allow you to benefit from both diversification and targeted growth or income while managing risk. The key is to align your strategy with your personal goals and risk tolerance. No matter your approach, the goal is always to stay consistent and stay invested. That's how you compound your way to financial independence. As promised, you may grab your free reference guide to growth and dividend investing using ETFs by signing up for our club updates. Just go to the link in the description below. If you found this breakdown helpful, please hit the like button and subscribe for more investing content. Drop a comment below and let me know, are you a growth investor, a dividend investor, or a mix of both? I'd love to hear your thoughts. Thanks for watching, and remember to always be compounding. See you in the next video. Take care.